Good morning, and thank you to the Master Builders Association for asking me to participate in this flash webinar. I'm Jeff Burd. I'm the owner of the Tall Timber Group and the publisher of Breaking Ground magazine for the Master Builders. I've been asked to talk about what's going on with the construction industry, something we're presentation entitled About Face, which we hope turns out to be accurate. What we faced last year was something that is relatively extraordinary. There may be a few thousand people alive the last time we had a pandemic, but most likely not. What we have is kind of two hurdles to overcome. One being a public health hurdle that is an obstruction to doing business as normal. Construction was able to, for the most part, continue with some minor drags on productivity, but the industry, the work in progress, was able to get underway. Unfortunately, behind the scenes, the overall economy was ground to a screeching halt for approximately 6 to 8 weeks, and then re-emerged in a much slower pace due to a lot of mitigation efforts necessary to bring COVID-19 under control. But what we didn't have was a recession that was caused by an imbalance, which is typically how recessions happen. There wasn't too much supply of something or too little demand, except for that which was artificial as a result of the virus. Where we are today is businesses are reopening, even with the current surge in infections. Those are mostly confined to areas where there's been much less vaccination. We happen in Western Pennsylvania to be sitting in an area that's pretty well vaccinated. Businesses are returning. Unemployment is falling slowly, which is a little bit of a surprise. In fact, at the national level, the number of openings is equal to that of the number of unemployed, but the matches aren't being made. Some of that is due to some concerns about re-emerging, maybe some safety concerns. But for the most part, there's a bit of a reallocation of the workforce going on. People that were doing jobs before the pandemic that they did not wish to do are beginning to reevaluate, and we're seeing as much as 10% of the unemployment be due to people who have just left their jobs. There's also a certain amount of this not returning to work that's happening because of the extended unemployment compensation benefits. As we went through the pandemic, that unemployment compensation, a number of other specific provisions of the CARES Act, of the American Recovery Plan, were the bridges to recovery that were necessary. They got their businesses through programs like Paycheck Protection, and the pandemic unemployment put us in a position where there was a lot less damage done than could have been. So we're looking at September and October as kind of being a key indicator of where we are, because that will have been after we've probably come through this surge. That will be after the extended unemployment runs out, and that should be sort of the inflection point when people really begin to return to work. What's driving the economy is the same thing that was driving it before. The consumer had a lot of savings and has been driving new spending, catching up on what wasn't done last year. Business has a tremendous amount of capital and reserves. Again, the programs that were meant to save business also allowed them to accumulate capital, and so you'll see a lot of business investment. I think the business failures and evictions, foreclosures, the things that we're concerned about, they still loom. We'll need to get well on the other side of this before we can fully evaluate it. But the bigger problems that are kind of coming out of this right now are in the supply chain. We'll see supply continue to be challenged by the extraordinary growth in demand. There were a lot of hiccups in the supply chain. There remain a lot of hiccups as the pandemic continues to be much more of a serious concern in other parts of the world. Some, if not all of those parts of the world, are key to the supply chain. So lead times on construction materials, pricing will be out of whack probably through or into the spring of next year. It should not hold up our growth. Growth as measured by gross domestic product or GDP fell about 3.5% from 2019 to 2020. We expect it to be up as much as 8 or 9% in 2021. That's the biggest surge in GDP since after World War II. The recent surge could slow the growth a little bit, but if it gets under control and if, as it's beginning to look, it becomes a further incentive for a new surge in vaccinations, we may be able to see that finally push COVID-19 out the door in 22. One of the other interesting things is that the mitigation and sort of the recession that spiked down and back up last year seems to have restarted the economy to some degree, or kickstarted it, in that the forecast for 2022's growth is still pretty aggressive, about 4%. In 2019, the forecast for 2022 was about 1.5%. So while it was a very painful period to go through, it appears that we're going to see an increase in demand next year that is pretty high. Just some graphs to sort of illustrate what's going on. This has been the job creation month by month since the recovery began in May of 20. As you can see, some very quick snapbacks followed by more ups and downs. We don't have July's data yet, but we expect that to be something in the order of what was in June. This is a chart of the GDP. As you can see, by September, by the third quarter, we're expecting that the growth level will be well above what the long-term trend is. And this is what's driving it. You can see the previous chart and this chart are nearly compatible, or nearly identical. Personal spending, which in this particular category, personal consumption expenditures, it has risen back above its long-term trend line. Now, the one boogeyman in the closet that we should be looking out for, that this is has a direct bearing on, is inflation. Right now, that's becoming a concern for our industry, but in the overall economy as well. What we're seeing is what they're calling transitory inflation. Make the point that it does not mean temporary. It means it will be changing. It may last a little longer than just 3 months or 6 months, although we expect by next year to see things sort of normalize as the supply chain normalizes. That's, as much as anything else, that's the biggest driver right now of inflation, is these imbalances in supply and demand. Just as a point of that, the consumer price inflation and producer price inflations through June have been driven by just a few items. And they're items that are not necessarily highly consumable, like used cars, for example. The price of a used car is up 27% year over year, and that has everything to do with the shortage of microchips and the shortage of new cars that's driving demand for used cars. It's going to put pressure on 2021 projects that were underway, and particularly those that were in pre-construction that had not yet been purchased. Now, the upside of this picture is that the long-term supply and demand picture for particularly the major items like steel and lumber and oil and gas have not changed. There's still an excess of supply globally for these products and these materials. Once these sort of hiccups get out of the way over the next 6 to 12 months, those will sort of reallocate to or go back to the normal trends that were long-term. This reallocation of the workforce does present a bit of a threat to wage inflation. If people are in great numbers leaving jobs that they don't want, it means that they'll be demanding higher wages in their newer jobs, going to jobs that pay higher, and those positions that were left will have to raise wages. And that does present a threat of reinforcing this sort of long-term cycle of inflation. What the bond market is telling us is not to worry about that. The long-term bonds are still trading at very low interest rates, below 2% for the 10-year bond, and 30-year mortgages are still at or just below 3%. What that tells you is that people that are asking for long-term debt are not being forced to pay higher interest rates because of worries about inflation. So if you look at where we are, and yes, it's a little concerning, the month over month inflation compared to last year when things were very slow. The long-term inflation rate has been around 2%. If you go back to the 1990s, it averaged above 3%. And as late as July 2006, the annual inflation rate was 4.5 or 4.6%. So where we are is not terribly unprecedented, and is likely to be something that doesn't drag the economy. Just as a bit of context, this is the trend over the last 3 years. As you can see, we had much higher inflation for construction materials in the middle of 18. That was driven a lot by some changes in prices in fuel. The long-term trend is still lower, so it's a matter of how we get through these next few months and in through the fall in terms of the supply chain and reestablishing the normal supply demand that brings inflation back down around 2% or 3% to see how that has an impact. Short of the inflation cycle derailing us, though, 2021 is shaping up to be a year that is establishing pricing contracts and meeting the demand of businesses and consumers, which is extraordinarily high in recovery from COVID-19. So unless and without some major setback in that public health area, the rest of this year, and in particular 2022, should be a booming time for construction.